Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Every single day, share prices change. Well, the liquid ones do. We aren't talking here about those zombie-listed companies that never trade. We are talking about the stocks that you can easily buy and sell on the market with a reasonable bid-offer spread thanks to a decent amount of liquidity. Those prices change every day due to a variety of factors. From time to time, they change by a big amount, usually based on the release of news. Inevitably, of course, this leads to people commenting on the prospects and the valuation and even something called the traded multiples. But what does it all mean? The fundamental principle here is future cash flows. An asset has value if you believe that it will bring you cash flows over time. It is actually that simple. No cash flows, no value. The valuation is therefore a function of three things. First, how big are those cash flows? Second, when are they expected to happen? Third, what is the probability of them happening? Now, those first two concepts relate to business performance and the art of forecasting how a business might do in future. The third concept is all about assessing the risk factors of the business and figuring out a reasonable rate of return for the risk. Valuations are complicated, fascinating things, but that is the most basic explanation I can think of for why a share price changes and actually what the share price even is. When these prices move, it means that something has changed across those three factors. I'll therefore deal with each one separately. First up, how big are those cash flows? To understand this, we need to talk about the assets of the business and how they actually generate income. You'll find that income on the statement of income and the assets on the statement of financial position, or what used to be called a balance sheet. You'll find the cash flows on the statement of cash flows. Now that all sounds kind of obvious, right? But here's the trick. Income, profits, and cash flows are not the same thing. For example, imagine a business that needs loads of stock and constant upgrades to its facilities in order to make a profit. Sure, there might be a gross profit from the sale of goods. That's great. One would certainly hope so. There might even be an operating profit after paying expenses. Even better, we have a business here. But then what happens to the cash? A big chunk of it, for example, might get tied up in inventory, which means it's not going to shareholders. Or the payment terms that are given to customers may be so favorable to them to drive sales that there are great profits on paper, but that money is getting tied up in accounts receivable, so the bank account is telling a very different story. And what about those facilities, those fixed assets, those factories that I referenced? They need to be built and maintained and expanded, all of which takes cash. Those cash drains would obviously be in the statement of cash flows, but wouldn't you see them on the income statement as well? And the answer is no, not immediately, not necessarily. Cash tied up in stock doesn't hit the income statement until that stock is sold and it comes through as cost of sales. So you can have great profits and absolutely no cash flow if all of it lands in inventory. When it comes to CapEx, it only hits the income statement over time in the form of depreciation. So the starting point for how big the cash flows are is to consider whether there are any cash flows at all. Cash conversion is the key concept here, or free cash flow, the cash after servicing working capital and CapEx. And by the way, we haven't even paid our debts yet either. All we've done is, pay for stock or stomach having accounts receivable or expand our facilities. Does a business have value if it generates a return on assets of, say, 10% before we pay debt, and then we borrow money at 10%? In other words, every cent is going into paying our debts, assuming we funded the assets entirely with debt. Yes, it does have a value because the assets are generating a return, but if they're fully funded by debt, there's no cash flow for shareholders right now because all of it is going to the banks. Over time, the cash generated by those assets should grow, whereas the 10% payable to the bank should hopefully not grow because it's on a static debt value. In fact, it's ideally on a reducing debt value because as the cash from assets grows, we are paying down the debt and we are expanding the value of the business. Now, this leads us very neatly into the second point in assessing a share price, which is when are the cash flows expected to happen, not just how big are they. When asking the question of when the cash will come, we are venturing into the world of forecasting. We are no longer just reading numbers off the financial statements. We are interpreting them, assessing how the business is performing, and then forecasting what the revenue and expenses will be into the future. If revenue is growing and costs can be managed, then profits should increase over time, and that is great news for shareholders because debt providers are getting a fixed return, whereas investors, equity holders, are there to get the upside. The quicker the upside comes, the more valuable the present value of those cash flows. And therein lies the magical term, the present value. This is the crux of finance, because the time value of money means that we need to express future cash flows in today's terms. Just think of inflation. 100 Rand today is not the same as 100 Rand 5 years ago, or 100 Rand 5 years from now. It's the same with cash flows from an investment. The thing to remember is that the sooner the cash flows are expected to come, the more valuable the company is, and therefore the higher the share price. Any news that suggests stronger near-term performance, like sales growth ahead of expectations or expense savings, for example, will almost certainly lead to a stronger share price. Conversely, news of delays to projects or a disappointing season for sales, even without any long-term negative impact, will still have a negative effect on a share price. Now that we know that we are dealing with present values of cash flows, the next important question is, what should the discount rate be to bring those future cash flows back to today's terms? And this brings us neatly to the third point, the probability of the cash flows happening. To be fair, this probability deserves a textbook on its own, never mind a portion of a podcast, but I'll try keep it as simple as I can. The higher the discount rate, the lower the present value of the cash flows, and therefore the lower the share price. Conversely, the lower the discount rate, the higher the present value of the cash flows, and the higher the share price. And the other important part of this puzzle, the higher the risk in the company, the risk of those cash flows, the higher the discount rate. So let's do that again with an example of each. A less risky company is going to have a lower discount rate applied to its future cash flows because we can be more certain of them. If there's a lower rate applied to them, we have a higher valuation today, especially relative to the profits that the business is making today. And this drives a higher valuation multiple. That's where you hear stuff like an earnings multiple. What are you paying for the share relative to today's earnings per share? ShopRite is a great example here. That is the market darling. Everyone assumes nothing will ever go wrong. It is seen as a low-risk stock, so investors are very happy to apply a low discount rate to those future cash flows and pay more for the shares today. Now, a more risky company has a higher rate applied to those future cash flows and thus a lower present value relative to its current profits, hence a lower valuation multiple. Think about small caps on the JSE stuck on price earnings multiples or PE multiples below 10x, sometimes even below 5x. The market doesn't have much faith that the cash flows are dependable, so they are discounted heavily. And this is exactly why something like an improved political situation means that all share prices in South Africa went up, because across the board, people felt better about the future and were happier to put a lower discount rate on the future cash flows. You can therefore see why the usual situation is that the sharpest moves in share prices happen after results are released, because sophisticated investors are absorbing loads of new information about that stock and acting on it. But that doesn't explain why share prices move every single day, does it? The daily grind is more about risk on and risk off, because the market is not getting new information about every single company every single day. But it does get a lot of other stuff. We get news on interest rates. We get news on economic growth. We get statistical releases, stuff like retail sales, for example. We have geopolitical events that give investors a higher or lower risk appetite. We have news from other companies in the same sector, or even adjacent sectors, which help investors form updated views on the company in question. If the biggest real estate investment trust in South Africa comes out and says, hey, our shopping centers are doing really, really well right now, especially the grocery stores, well, guess what? Investors read that and say, okay, that's good news for grocery. Maybe I'm happy to pay a bit more for those stocks, even though none of the grocers actually released fresh news. So share prices move every single day because of the inputs to the valuation or the share price changing a little bit every single day. But ultimately, it always comes down to those three things: the size of the cash flows, the timing of the cash flows, and the risk attached to them. When you see a share price move, ask yourself which of those factors is causing the biggest move, and it will go a long way towards helping you understand what is really going on every day in the market and whether or not those movements are reasonable. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.